Good day. Welcome to another session of 4 tutorials. Today we are going to look at the final account of a sole trader. The final accounts of a sole trader. And so final accounts are basically accounts that are prepared by entities at the end of the accounting year to show their profitability, their financial position, their cash flow position for the period. Alright, and so we have so many forms of business organizations, but our focus is on final accounts of the sole trader alone. And so we want to quickly look at what constitutes the final account of a sole trader. Now, the final account of a sole trader has been what we know has been the trading account, the profit and loss account, and the balance sheet. And so we used to know of the trading account. We know of the profit or loss account, and then we know of the balance sheet. Okay, and so what we know is that the trading account is prepared at the end of the year to show the gross profit or loss, and then the profit and loss account is prepared to show the net profit or loss. And then the balance sheet is prepared to show the financial position of the business. Alright, and so these are the three statements. But what we do is that we usually prepare the first two together as one statement. And so we used to call it trading and profit and loss account. Now, as accounting is evolving, the name has evolved as well. And so we no longer call it trading profit and loss account in a professional way. But what we call it is that we call it the income statement. And so we are going to say that the final account of a sole trader are one, the income statement. And then the balance sheet also, since it's prepared to show the financial position, is also now called the statement of financial position. Okay, so basically we say that the final account of a sole trader are the income statement and the statement of financial position. So these are the two statements that we are going to focus on. Now, the income statement, remember, is a combination of the trading account and the profit and loss account. And so you should understand that in the income statement, there is a trading account and there is a profit and loss account. And so still, we are going to prepare the component that is the trading account to ascertain our gross profit or loss. And then we are also going to prepare the profit and loss account to ascertain the net profit or loss. But we prepare them together and then we call it the income statement. And then the statement of financial position will be prepared as well to show the financial position of the business. Alright, so that is basically what we are going to do. So we are going to look at the income statement. And I told you earlier that the income statement is made up of the gross profit determination and the net profit determination, which is the trading account and the profit and loss account. Now, the big deal here is the trading account component, because the profit and loss portion is basically indirect expenses that are matched against those of the other income. And so what we are going to do now is basically understand the concept of the trading account as in the income statement. Now, it's very cumbersome and I just want you to follow. Our main objective is to determine profit. That is the gross profit, but it's profit. And I want us to take our minds back to our profit determination as far as our business mathematics is concerned. Basically, we know that selling price minus cost price is our profit. This is what we know from business mathematics, that selling price minus cost price is profit. Now, if this is what I'm selling, now this equation basically is per unit. Okay, so if I am buying this marker, for example, per unit of a marker, I can call it selling price if I'm selling it. And if I bought it to sell, the amount that I bought this marker is my cost price. And then profit is the difference between how much I bought it and how much I sold it. Now, when we take it in bulk quantities, you cannot call it selling price when it is in large quantities. So selling price will change to sales. Now, cost price is supposed to change to purchases, and profit remains the same. And so when they are in bulk quantities, the equation changes to sales minus purchases. Now take note that purchases alone is not enough to compare to sales, because there are other direct expenses that are related to purchases that also forms part of purchases. Okay, and then there can be stock, closing stock and opening stock components. And so instead of purchases, to give it a better name, we call it cost of sales. So profit still remains, our sales still remains. And so the profit equation that we are going to look here is our sales minus our cost of sales. That will give us our profit. Now, because I told you that there are a lot of adjustments as far as purchases is concerned, there is also going to be some adjustment on sales, and there is only one adjustment, and that is what we call, okay, for now, let's look at the name. Because there's going to be an adjustment of sales, whatever sales that we are going to have is called net sales. And so basically, the formula that we are going to use for the gross profit determination is our net sales minus our cost of sales. And so we are going to look at the components of each of these net sales and this cost of sales. What goes into the cost of sales and what goes into the net sales before we determine our profit. Okay, so like I said, our net sales minus cost of sales equals to our profit or our gross profit. All right, so this is basically what we need as an equation. This is what we need as an equation. Now take note that in order to get the net sales, okay, it is your sales minus your returns inwards, or what we call sales returns. And so when you take out your return inwards from sales, you get your net sales. Sales is reduced by returns on sales. And so when we make sales and then the customers return them back to us, the returns that are made reduces the value of the sales, and that is how we get our net sales. Now when we get to cost of sales, now cost of sales is a very big component, and so let me just try and let you understand the concept of cost of sales over here. And so cost of sales. Now what is cost of sales? Cost of sales has to do with the cost that we incurred in the sales that we made. And so if I have 100 quantities of item in stock and I sell them, let's say I'm able to sell just 80 of them, the cost of sales is the cost I incurred only on the 80 that I sold and not on the whole 100. That is the mistake we make sometimes. And so if I have 100 items in stock and I sell 80, the cost of sales relates to only the cost of the 80 that I sold, not the cost of the items that I have. And so if I bought the 100 for, let's say, 100 cedis, and I want to know my profit, maybe I sold 80, I should determine the profit of the 80 that I have sold. And so to be able to determine the profit of the 80 that I sold, I can't match the revenue I generated from the 80 to the cost that I incurred on the 100. That would be a mismatch. And so there should be the cost of the 80 matched against the revenue for the 80. So the cost of the 80 will be matched against the revenue for the 80. And so cost of sales basically is the cost of the goods that you have sold. And so like I said, if I have 100 goods in stock and I sold 80, then it means that I'll have 20 left. And so to know, for example, if I have 100 goods in stock and at the end of the period 20 is remaining, the 100 that I have in stock is the goods that I had for sale. So this 100 is my goods that are available for sale. Now if at the end of the period I have 20 in stock, how much did I sell? Obviously it's a simple mathematics of taking out the 20 from the 100 to get the 80. And so this 20 is my closing stock. That is the stock that is remaining. And this 100 is the goods available for sale. So that is the goods that I had available for sale. So if this is the cost of the goods that I had available for sale, and at the end of the day I had 20 cedis of the stock remaining, then it means that I sold 80 out. And so this 80 is what we call cost of sales. And so before we determine our cost of sales, we should be able to take out the closing inventory or the closing stock from the goods that were available for sale. So this 80 is the cost of sales, like I said. And so you see, before you can get this 80, there should be goods available for sale. And then you take out what is remaining at the end to get the cost of sales. Now, this cost of sales, before we get the goods available for sale, let's come back to the goods available for sale. Now, goods available for sale are the goods that you have at your disposal at the beginning of your period to sell. And so normally these goods available for sale that comes in two different components. Remember that with the example that I just gave, I said that we have 20 goods that are left at the end of the period called closing stock. Now next period, no businessman will throw away this 20 CD worth of goods. No. So this 20 CDs worth of good that is remaining will begin the next period. And so next period we are going to have 20 at the beginning. And looking at the demand that we have, we sell on the average, we sell 80. So we know that this 20 will not be enough. So we can go and buy more to add up. So we call this 20 my opening stock. As a sole trader, this is the opening stock for the beginning. The closing stock will become the opening stock. And so if I go and I buy, let's say 90 more, so this will be called my purchases. Now these purchases will mean that I have a total of 110 to sell for this year. This is last year's analysis. This year I started with the 20 from last year, and then I have bought 90 more and I have 110. Ladies and gentlemen, this 110 is my goods, cost of goods available for sale. This is what I have to sell. And so what I wanted to let you understand is that basically the goods available for sale, or the cost of the goods available for sale, has two components, which is the opening stock and the purchases. And so this 100, there is a component that was starts an opening stock, and there is a purchases component. And so in order to get this cost of sales, we need an opening stock plus purchases, which is going to give us the goods available for sale. And then at the end, we less out the closing stock, which is going to give us the cost of sales. So this is the expression for the cost of sales. And so to get the cost of sales, it is your opening stock plus your purchases minus your closing stock. Now coming back to purchases, remember that I told you that sales is reduced by return inwards. And so purchases will also be reduced by something, and there is an adjustment on purchases. And so these purchases that is inside the cost of sales calculation is also called net purchases, because there will be some adjustments on the purchases. Okay, so when we want to look at cost of sales, cost of sales is a function of opening stock plus your net purchases minus your closing stock. So this is how we ascertain the cost of sales. And remember that I said that these two, when you add them up, we call it the cost of goods available for sale. Then we take out the closing stock. Then we have our cost of sales, or cost of goods sold. Then this net purchases is the final thing that we have to talk about. Now, why do we call it net purchases? Because there are some adjustments on purchases that will reduce or increase the value. Now, there are some direct expenses on purchases that are either added or subtracted from purchases. It depends. Now, net purchases means that your purchases figure, as raw as it is, there are some direct expenses that are allowed to be added to purchases. And one of those is what we call carriage inwards. Carriage inwards. Carriage inwards means that, I don't know if you see, it's like carrying something, a load into the business. When you go and buy, and maybe they put it in a truck to come and accompany you, the truck that brought the goods into the business, the amount that you incurred on the truck, if you paid it, is carriage inwards, and it's a direct expense on purchases. And so we add carriage inwards. And so also we have returns outwards. Now there is another direct expense called freight charges. Freight charges. And that one also refers to when the goods, especially when the goods are being transported from international communities and they are sent by an airline. And so we incur freight charges. It's just like the carriage inwards, we add it up. And so we also have what we call returns outwards. Returns outwards is subtracted from purchases because it's also called purchases returns. When we buy the goods and we think, like the sales returns, when we buy and we think that these goods are faulty, we return them. It reduces the value of our purchases. And then finally, if there is stock drawings or goods drawings. Now, when we buy the things and the owner of the business decides to take some for private use, that one also will reduce the value of the purchases. So when we talk about the net purchases is basically your purchases plus any direct expense on purchases, which is carried inwards or freight charges. Then you take out the returns outwards, and then you also take out the goods drawing or your stock drawings. And this is the net purchases that we are talking about. And so in all, this is what I mean by what I'm saying. Okay, so the equation for ascertaining the gross profit is net sales minus cost of sales equals to the gross profit. Now, to get this cost of sales, I said that it is your opening stock plus your net purchases minus your closing stock. And so this is expression 2. So your opening stock minus plus your net purchases minus your closing stock. That gives you the cost of sales. And I said these two is the cost of goods available for sale. Then to get the net purchases alone, you also need your purchases plus if there is any carried inwards minus your returns outwards minus possible goods drawings. And then if there is any freight charges, you add it. So this also gives us a third expression. And so we have 3 levels. This is the main equation. But remember that you cannot get the cost of sales until you do these workings for these 3. And you cannot get the net purchases for that unless you do this. And so the format that we are going to look at will show 3 different levels for 3 different currency signs. So that we will use one currency sign for each of these 3. And so take note. And so this is how the format will look like. Alright, so we are going to look at the format of the income statement. Okay, and remember that I told you that the income statement has 2 components, the trading account component and the profit and loss account component. And so we are going to take them one by one. And so we begin by writing, this is how it's going to be done. Income statement for the year ended. And then you bring the year of preparation of the account, the end of the year. And what we are going to do is that we are going to begin with the trading account component. And so you are supposed to bring 3 currency signs. Three currency signs. And this is what we are going to do. Now, looking at the equation I gave, I said that sales, net sales minus cost of sales equals to gross profit. So this is what we are going to do. Net sales minus cost of sales equals to gross profit. And so what we are going to do is that we begin with our sales. So all the time you begin with your sales revenue. And then you can record that on the last currency sign. You record that on the last currency sign. If there is any adjustment on the sales returns will be subtracted from the value of the sales revenue, and then you have your net sales. So this is how you go about it. Your sales minus any sales returns, and then you get your net sales. Now in a question where there are no sales returns, your sales revenue or your turnover equals to your net sales. Alright. And then from here we take out our cost of sales to get the gross profit. And so we will say less cost of sales. Now, with the cost of sales, I told you that to get the cost of sales, it is your opening stock or your opening inventory plus your net purchases. Then you take out your closing stock or your closing inventory. That is what gives you our cost of sales. So what we are going to do is that we are supposed to get the cost of sales, and we are supposed to put that figure right under the net sales so that we will subtract it from the net sales in order to arrive at our gross profit. But the cost of sales will not be given to you automatically in the question. What will be done is that you'll be given other information that will enable you to calculate your cost of sales. So what you are going to do is that you will make use of this currency sign, the second currency sign here. Then you calculate your cost of sales, and then you bring the final figure under the last currency sign so that you would subtract to get your cost of sales. And so we said we will begin with our opening inventory. So opening stock will be recorded on the second currency sign. On the second currency sign. Then we add our net purchases. Now, take note. I told you that these net purchases that we are going to add also may the purchases may have some adjustment. We don't just add purchases to this side. When there are no adjustments on purchases, then purchases will be added straight to opening stock. But when there are adjustments on purchases, then we have to adjust them and get a net figure for purchases before we bring it here. And so if you have a question where there are return outwards and you have carriage inwards and you have freight charges, you have goods drawings, those are adjustments on purchases. And what you are going to do is that because they are adjustments on purchases, you first have to adjust the purchases figure and get the net purchases before you bring that figure to add up to the opening stock. And we don't do them outside. All those adjustments will be made on the statement. But what we do is that because we need to record the net purchases on the second currency sign, then we have to do the adjustments on the first currency sign. And so we will write our purchases figure on the first currency sign. Then we do all the adjustments on the purchases. And so if there are carriage inwards, we add the carriage inwards to the purchases figure. If there are any freight charges, to be added to the purchases figure. Now, if there is any returns out or purchases returns, that will be subtracted, because I told you that when we are subtracting, it should be in brackets. And then if there was any stock drawings, any stock drawings will also be subtracted. And so what I have done is that basically I have adjusted purchases. I have adjusted purchases. And so my purchases figure plus the carriage inwards plus any freight charges less any return outwards and then taking out goods drawings will give me a figure that I will put exactly on the line where I have the last figure. So I'll transfer it to the right side, and ladies and gentlemen, this is my net purchases. This is my net purchases, and so I'll add the opening stock now to the net purchases. And so what we basically do is that we are supposed to add the net purchases to the opening stock, but because the net purchases will not be given directly in the question, we'll have to make use of this side to work our net purchases and then add them up to the opening stock. And when we add the opening stock to the net purchases, we are going to get a figure that we call cost of goods available for sale. Cost of goods available for sale, like I told you earlier. And so when we get our cost of goods available for sale, then obviously the next thing to do is to take out our closing inventory. So we less our closing stock from the cost of goods available for sale in order to ascertain our cost of sales. And then when we take it out, we now have the cost of sales. Remember that we needed the cost of sales to be taken out from the net purchases so that we can have our gross profit. And so when we have the cost of sales, we now transfer that figure here, and then now we take it from our sales revenue, and then whatever figure that we have is our gross profit. And that is how we can end the trading account component of the income statement. All right, now let's take this as well. Now let's assume, now there are times where the cost of sales may have a different adjustment, in the sense that you can have wages outstanding alone. That is not mixed up with salaries. Now remember that in a typical financial statement for a sole trader, there are times you will see salaries, so at times you see wages, and there are times you see them combined as wages and salaries, or salaries and wages, whichever way they will put it. Now let's take note that wages is a direct expense, but salaries are indirect. And so what happens is that for the profit and loss account, we are going to only take out indirect expenses. Now when wages are combined with salaries, all of them become indirect, because we cannot take out the direct components from the indirect. But when wages is made to be standing alone, that means that they are trying to let us understand that that is a direct expense, and direct expenses do not go to the indirect expenses column. And so what we do is that, because wages is a direct expense, it should be added to the cost of sales before we take it out from the closing inventory. And so basically what we are going to do is that when you have a question where wages is present, let me try and reverse this situation and explain this to you better. And so what we would have been done is that once you take out your closing inventory, you are not taking the cost of sales directly to subtract from the net sales, but you have to bring it down, and then you can now add your wages. And so when you add the wages, then the final figure will be your actual cost of sales, which will be taken out from your sales revenue. And so remember that I told you that when you get a question where there is wages direct, then that will not go to the profit and loss account. That one will be taken out from, that one will be added to the cost of sales, and then we will take it out from the net sales revenue to get our gross profit or loss for the period. Okay, so this is where the trading account ends. So the trading account component ends at your gross profit or loss. And once you get the gross profit or loss, that is the same place the profit and loss account component will begin. So what we are going to do is that for the profit and loss account component, it's just a very simple thing. The actual work is to understand the trading account. For the profit and loss account, what we do is that we just add other incomes, and then we take out other expenses that are indirect. And so what we do is that right after gross profit, you can see add other income. And then there can be a lot of other incomes that you can add. We have discount received, investment income, and a decrease in provision, a whole lot of other incomes that can come. But I will take my time to explain adjustments when it comes to income and expenditure. And so what we are going to do is that let's assume that we have just two incomes, discount received and then investment income. Now in that case, then we are going to add that, and then we find the total. And so the other incomes that are added will be, we add that to the gross profit, and then what we have, your gross profit plus your other income gives you a total income. This is your total income. Now after you have your total income, then you take out your indirect expenses, and once you take out your expenses, the resultant figure will be your net profit for the period. And so I'm going to begin from the total income column up here, and I'm going to take out some common expenses in order to get our net profit. Okay, so now we have our total income, and then the total income, what we do now is that we just take out our expenses. We are preparing it together, but then I'm starting afresh because of the space I have. And so we will less expenses, which are indirect expenses. And then some of these common indirect expenses are bad debts. We list them on the second currency sign. So discount allowed is an expense. And then we can also think of depreciation of non-current assets as expense. We can think of salaries as expense. And then there are a whole lot of expenses that we are going to meet. And so let's assume that these are the 4 expenses that we incurred as a business. And so we add them up, and then we bring the total here to match against the total income. And once we are able to subtract our total our expenses from the total income, and then we have our net profit or loss for the period. Ladies and gentlemen, this is how a typical income statement for the sole trader will look like. Okay, and so the next thing that we are going to do is that we are going to look at the statement of financial position, or what we call the balance sheet for the sole trader. Okay, all right. So we are going to look at the statement of financial position outline for the sole trader. Now, remember I told you some time ago, I told you that the statement of financial position is an extra from the accounting equation. And so we are going to look at how to prepare the statement of financial position in a very simple way using the outline of the accounting equation. And so let me get back to that. Now take note, we know that the accounting equation is that our assets should be equal to our capital plus liability. This is the basic thing that we know. Okay, and then this equation, asset plus capital, asset equals to capital plus liability, can be expanded. Okay, so what we do is that we assume that this C, which is the capital, is the owner's equity. And when we take a sole trader, what is his equity? He puts in capital, it's only reduced by his drawings, and when he makes profit, he adds it. If he makes loss, it will be subtracted. I mean, that is the dynamics of the equity component of the sole trader. And so this C basically is your capital minus your drawings plus profit as a sole trader. That is, this whole bracket represents the C. And so to continue what I was doing, I would say that our asset will now be equal to capital minus drawings plus profit plus our liability. Ladies and gentlemen, this, what I have done, is the same as the accounting equation I put out there. The only difference is that I have expanded the capital. Alright, now look at the assets and liability. We have two main types of assets, two broad classifications, even though we have other types. But the two broad classifications that we know is our non-current assets and our current assets. Okay, and so what we are going to do is that let us try expanding the assets into non-current assets and then current assets. The non-current asset is what we used to call the fixed asset. And so it will be equal to our capital plus our capital minus our drawings plus the profit. Plus, and then the liability also, we have two broad. We have the non-current liability and we have the current liability. The non-current liability is the long-term liability. So when we get to the liability side also, we split the liabilities into non-current liabilities and the current liabilities. The non-current liabilities are the long-term liabilities and the current liabilities. Okay, so what I will do is that I will say that plus my long-term liability and my current liability. So this is an expansion. Ladies and gentlemen, what I have done is no different from the first equation. Now, this is the original accounting equation. This is also the same equation, but it's just that it has been expanded. And this is the format of the balance sheet or the statement of financial position. And so look at the expansion very well. What I have done is that I have just expanded it. Now this is when you want to go by the total asset way. If you want to go by the working capital way, then what we are going to do is that we say that working capital is your current asset minus your current liabilities. And so what we are going to do is that we cannot go the working capital way if the current assets and current liabilities are on opposite sides. So we bring the current liability to the side where it can be matched against the current assets. And so your non-current asset plus your current asset minus your current liability will be equal to your capital minus drawings plus your profit plus your long-term liability. And ladies and gentlemen, this one is the format of the balance sheet or the statement of financial position when we are going by the working capital way. And so what we are going to do is that we are going to go this way from the left to the right. And I want you to write this formula somewhere because this is what we are going to do. We are going to start with our non-current assets, then the current assets. And so let me put this in bracket because we are supposed to take out the current liabilities from the current asset before we add the resultant figure to the non-current assets. And board math has taught us that for everything we do the bracket first. And so when we start with the left side of the equation, we will go this way, but we'll make sure we get a figure for working capital, and then we add it to the non-current asset. And then because of the equal sign, what we'll do is that we rule off, and then we call it our net assets or your capital employed. Then you go to the other side, and what we are saying is that these net assets were financed by, these were the sources of finance, the owner's equity and the long-term liability. And so once you rule off, you say financed by or represented by this plus that. And then these two sides must be equal because of the equal sign and because of the accounting equation. So why must the balance sheet always balance? Why must it balance? It should balance because of the accounting equation. Alright, so that is basically what we are going to do. And so putting this equation somewhere, non-current assets plus your current assets minus your current liability equal to your capital minus drawings plus profit plus long-term liability. I'm going to start the format of the statement of financial position, and then I'm going to go according to the same equation that I have given you. Alright, so what I'm going to say is that I will say statement of financial position as at, and then the date will come. So as at whatever date that you are preparing it. And then let's also create 3 currency signs for that. Okay. And so we are going to go according to this way. We start with the non-current assets, then we come to the current assets, we take out the current liabilities, and then we rule off. And then we start the other side of the equation. Our capital, taking out our drawings plus profits. In brackets, get one figure as an equity, and then you add your long-term liabilities. And so we begin with non-current assets. Non-current assets. And so non-current assets, what are the types of non-current assets that we have? Let's assume that for this very sole trader, he's using motor vehicle and then some buildings. So these are the non-current assets for this very sole trader. And so what we do is that we have to analyze them into our cost and then take out the depreciation and then have our carrying amount or net book value. And so what we do is that we can have a cost and then we put here as accumulated depreciation, and then our net book value will be here on the line where I wrote the non-current assets. Okay, and so we will just, for now, let me just put their net book values here, because this is the most important part. When I'm doing adjustments, I will come back and explain this. So we will put your non-current assets on the last currency sign, and then you add them up. Now, when you add them up, you have a line. Now, on that line is your total non-current assets. You may decide not to write anything there. Then you come to the next item in the equation that I expanded, which is your current assets. Now, what I'm doing is that make sure that you don't write the current asset on the line where you have your total because it is empty. That will be tempting. That will mean that you are naming this total as current asset. It's very risky. Okay, so let's desist from that. Okay, so when you write your current assets, then you begin with the current assets. Current assets are arranged in the order of liquidity. And what do I mean by liquidity? In the order of how easily it will be to convert them to cash. And so when you are starting with the most liquid, you end with the less liquid. If you are starting with the less liquid, you end with the most liquid. So you can decide to begin with any of them. All right? But usually we begin with inventories, which is very less liquid, to cash, which is most liquid. So that is what basically we do. And so if you want to go by that way, then it means that we'll bring our inventories first, then our receivables will follow, and then our short-term investments, and then our cash. All right, so the current asset, we have our inventories or stock, and that should be recorded on the second currency sign. Did you see that I wrote the current asset on the last currency sign? The non-current should come under the second currency sign. And so if there are any trade receivables, what we used to call debtors, then that will also come. And then if there are any short-term investments, that will also appear. And then your cash will come, which can be your cash in hand or your cash at bank. All right. And so once you have your current assets, you bring the totals down just like you did for the non-current assets. So now we are done with the non-current asset. We are done with the current asset. The next thing on the equation is your current liability. And that one, the sign that is attached to it is a negative sign. That tells us that when we finish listing, we will subtract from whatever things that we have. So we leave a line. At the same time, like I said, make sure you don't name this your current liabilities. So you descend down and say current liabilities. And your current liabilities for a typical sole trader is trade receivables, trade payables, usually, and then some other liabilities like your income tax, if only the trader waits for a while before they pay. So we can have your trade payables, and then we can have income tax as a liability. And so for that, what we do is that we record that on the first currency sign. Now look at the way we are doing this thing. It is slanting like that. We started from the last currency, then current asset came to the second one, and then we are now on the first currency sign. And so we add up the current liabilities on the first currency sign, and then we bring the total here, and we put it in brackets because we are subtracting. The sign is negative on the equation, so we subtract from the current asset. And when we subtract from the current asset, the final figure, I told you that this is in brackets, and so we do the bracket first. So we have to subtract from the current asset, get our working capital, and then bring your working capital figure here. Now usually we put them on the same level as I'm doing, but sometimes you can decide to descend this figure down and name it working capital. It's also acceptable. And so when you put your working capital here, now your working capital will be added to your non-current assets. And when your working capital is added to your non-current assets, then you have your capital employed. Or the net assets. And so when you have the capital employed, I have ruled it off because I have ended one side of the equation. This is our capital employed. And so once we get the capital employed or our net assets, then this asset, we are finished with one side of the equation. And so that is why I have ruled it off. So the other side of the equation means that this is how these assets were financed. And so we will say, after this, we will come and say financed by or financed by. Now, it means that these assets were financed by the components on the right side of the accounting equation. And so that will be, we will begin with what is in brackets because of the board mass rule. And so we will say our capital, that is the C. So the capital of the sole trader will appear. And then you take out any drawings that is made. We do all on the last currency sign. And then if there are any profits, we bring the net profit that we got from the preparation of the income statement. That net profit will be added here. And then we have the owner's equity. So it is your capital minus your drawings plus your profit. Then you have the owner's equity. So this is the bracket. The last thing that is left is the long-term liability. So if there is any long-term liability, it can be more than one. You list them. If there are any long-term liabilities, you add. Okay, long-term liabilities can be loan and all that. Debenture usually is in the case of a company. All right. So once you add up your equity and then the long-term loan, then you have the same figure that you have up there. Let's say this is BBB. So if you are having BBB here, you should get the same BBB. What I'm trying to say is that this and that must be the same. Then we say that the statement of financial position has balanced. That means that whatever you have done is right. And it should be balancing because of the accounting equation. And so this is how we go by the format for the income statement of the sole trader and the statement of financial position of the sole trader. In our next video, we are going to take a question without adjustments, and then we'll look at how to arrange these things. And then subsequent video, we will treat the adjustment for this final account into details, and then we will take our time to solve practical questions. Thank you.